Hey guys, Eric Martel here. Are you ready for 10% mortgage rates? You don't think it's gonna happen, do you? Well, let me tell you, as there was a time in this country where mortgage rates were as high as 18%. And my mortgage rate on the first house that I bought was 13%. So it is possible, it did happen, and it could still happen today. In this video, I'm gonna share with you what needs to happen for the mortgage rate to go this high. I'm gonna share also some strategies for protecting yourself against high mortgage rate. And I'm gonna tell you exactly what I think is gonna happen with the mortgage rates this year. But first, make sure you like and subscribe, because if you're not watching my videos, you're putting your finances and your future at risk. So I've been in real estate for decades, and I want to tell you that you have to be open to different possibilities in terms of what could happen to mortgage rates. So when I bought my first house, the mortgage rate was 13%. And at the time, it was a great deal. I know it sounds high, but it's still a lot better than what it used to be in the 80s, which was 18%. So people are really scared that if the mortgage rates goes up to 10%, we're gonna have a real estate crash, because nobody is gonna be buying houses because it's too expensive. But what happens is that the housing, there's two options on housing. Either you pay a high rent, because you can see that the rent is really going high very quickly right now, or you're gonna pay a higher price on your mortgage. One of the reasons why I'm predicting that the rent is also going to increase rapidly is that a lot of the people it's not going to be affordable for them to buy a house, so they're going to choose to rent instead. It's going to increase the demand on rental properties, and the rent is going to go up that way. In fact, we're seeing rent increase very rapidly right now. In fact, Realtor.com put out a figure that the rent have increased 16.7% over last year. In some of the most expensive cities, the rents have increased 50%, like Miami. If you buy a house today, your mortgage payment are going to remain the same for the next 30 years. So it is, from that perspective, is going to be more stable than if you rent, and then you're going to experience rent increases of 10, 15% year over year. Having a mortgage is also a great way to protect yourself against inflation, because you're borrowing money in today's dollar, we're paying it back in future dollars where the purchasing power is lower. So if you think that this high mortgage rate is gonna cause a real estate market crash, it's not gonna happen. So how do interest rates get over 10%? So let's look back at the last time when this happened, which was in the 80s. So it really started with the oil crisis of 1979. So a significant reduction in supply of oil, which caused a massive oil price increase in the United States as high as 50%. And this is something that we're seeing right now worldwide. I mean, with Russia cutting oil to Europe and to Finland and Sweden, which is causing the oil prices to go up to levels we haven't seen before. So in the 80s, when this happened, when the supply of oil was reduced, the price of oil and the price of gas went through the roof, and it caused inflation. And when the price of oil goes up, the price of everything goes up. That means like clothing, that means food, furniture, everything. And in the 80s, this caused the inflation to go as high as 13.5%. So the Fed, in order to curb inflation, decided to increase interest rates higher and higher and higher up until it reached 18%. And by the way, the Fed in the 80s increased the rate very rapidly over a short period of time. This is also something that a lot of people don't think could happen, that the Fed would increase rates so rapidly. But if the inflation gets out of hand, the Fed will definitely increase rates very rapidly, very quickly, in order to slow down the inflation. So why is inflation bad, high inflation bad? So high inflation really affects the behavior of consumers. They're gonna ask for a higher raise, they're gonna cause product substitution, they're also gonna change the way they spend. Normal, inflation around 2 to 4%, people don't really change behavior. When the inflation goes and hits 8%, 10%, 12%, this really affects behavior and affects behavior very quickly. When there's a high inflation rate, people know that their purchasing power is at risk, is going to be reduced over time. So people are traditionally looking for asset classes where that's going to protect their purchasing power. So they're going to look at, a lot of people look at gold and precious metals because they know that it's going to be stable or increase during high inflation period. They're also looking at hard assets like real estate because they know that's also going to keep its value over time, especially if you're mortgaging, you're using leverage on a real estate, it's really going to preserve your purchasing power. So this is why it's causing a lot of demand in real estate, and this is why the real estate prices are going up rapidly. So when the Fed sees that there's such a skyrocketing demand and skyrocketing prices, they want to keep that under control, and they're using interest rates to do so. When they increase interest rate, it reduces the demand because it makes it less affordable for people to buy real estate. For instance, if you're trying to buy a home and then the interest rate goes up, your mortgage payment are going to be higher. It's going to make it less affordable, and therefore some people are not going to be able to afford that. And because fewer people are able to afford it, it's going to reduce demand for real estate. So there are a surprising number of similarities between what happened in the 80s and what is happening today. One of the similarities is the gas prices. In the 80s, the gas prices went through the roof because of the oil crisis. We're seeing the gas prices going through the roof here as well. And with the Ukrainian war, I think that the gas prices could go even higher. Second similarities is inflation. In the 80s, they saw the inflation go up rapidly month after month, and we're seeing the same thing today. In the 80s, it went as high as 13.5%. We're not quite there yet. We're at 8.3% last month, but I suspect that it could go even higher. And the third one is interest rate. So in order to respond to these two crises, the government in the 80s decided to increase interest rate, and we're seeing the same thing today, is that the Federal Reserve is not only has increased interest rates, but is also signaling that they will continue to increase interest rates every month till the end of the year at least. So can the interest rate reach 10%? Well, the Fed already signaled that they're planning to increase the interest rate by at least a quarter point a month until the end of the year. So what could bring it to a 10% mortgage rate is an inflation that's going higher than we anticipated, and then the Fed responding by increasing not just by a quarter point, but decided to increase by half a point. And that could really accelerate the rate of increase. Also, the Fed may decide to, at the end of the year, to continue to increase interest rate in January of 2023, and February and March, and pretty soon we're going to be at 9, 10, 11% mortgage rate. So I'm not saying that the interest rate is going to get to 11, 12, or 13% like it was in the 80s. But 10% is definitely not out of the realm of possibilities. So what would be the impact of having mortgage rates at 10%? The major impact would be a reduction in demand for real estate, basically because it would make it less affordable for people to buy a house. The mortgage payment would be significantly higher, and then people wouldn't have the salary or the income to basically afford that mortgage rate. So is this going to be Armageddon? Is this going to be a real estate market crash? Is that where we're heading? I don't think so. So remember that prices is determined not only by demand, but it's demand and supply. So on one hand, yes, we can have a decrease in demand, but in order for the prices to really go and crash all the way down, you also need to have a massive increase in supply. So a Redfin economist just said that we were at 4 million houses short in the United States. So we're actually in a negative supply territory. So the real estate market is not going to crash, because in order for that to happen, we not only have to have a reduction, significant reduction in demand, we basically have to have an excessive supply of homes. We're already short 4 million homes. So for us to get into an excessive supply is not going to happen. So how do you protect yourself from high interest rate as high as 10%? So here I'm not trying to make one particular prediction. It's kind of pointless to be predicting one particular interest rate and then positioning your entire investment based on that assumption and that prediction. So what you need to do is position your portfolio to handle any kind of interest rates or economic situation that could happen in the future. Because interest rates are going to go up and down throughout your lifetime. Also, economists can't even agree on what the interest rate is going to be by the end of the year. And it's important for you to be prepared for multiple scenarios. especially 10% mortgages, which is in the realm of possibility. So if you look at today's rate and compare it to what it was a year ago, yes, the interest rates are higher. But you need to look at the future, and if the rates are going to continue to go up and it looks like it's going to head that way, then the rates today are going to be lower than they will be 6 months from now. So it's a good time to lock in that interest rate. So now may be the best time to buy a house. So basically look at all your adjustable rate loans out there and see how much it would cost if the interest rate was to hit 10%. Is this something that you can afford? Is this something that you want to pay? If not, then you may want to restructure these loans and lock them in for a longer term. Realistically, are we going to hit 10%? Well, I'm saying that you need to consider that as part of your assumptions. Again, you need to be prepared for all eventualities. People lose money, they lose their shirts, they lose everything because they didn't prepare for one eventuality. They didn't believe that the interest rate would go to 10%, 15%. What I want you to think is look at your portfolio, look at your loan, and be prepared to make sure that if this happens, then you're protected. You're going to be fine, And if it doesn't happen, you're still going to be fine. There's nothing wrong with having an interest rate locked in at 5% or 6% today, even if the interest rate goes down to 4% in a year from now. That doesn't hurt you. But if you don't lock in a rate and all of a sudden the interest rate goes to 10%, oh no, it goes to 12 or 14%, then you're screwed and now you have to sell everything in order to pay that loan off. That's the problem. Is 10% a possibility? Definitely is a possibility. And you need to plan for this if you don't want to lose your shirt. And make sure you like and subscribe because the real estate market is crazy right now and you need to know exactly what's going on.